Would you like to receive easy money? Well, easy money doesn't exist, but sometimes the stock market offers opportunities that look like bargains if you understand what's going on. Today I'm talking about UnitedHealth Group and why it might be one of those rare cases. Here I try to make sense of a sector that is often labeled too complicated and help you understand the dynamics, always with an eye toward potential opportunities. UnitedHealth is the largest health insurance company in the US. Until recently, it was considered one of the safest single stocks in the market, even a favorite among dividend investors for its low volatility and steady growth. But then, things changed dramatically. As we all know, in December, UnitedHealth's CEO, Brian Thompson, was killed by Luigi Mangione. The stock dropped around 18% in the period immediately after, but quickly recovered, as if the worst was behind us. Instead, 2025 brought a wave of negative news that crushed the stock by over 50% in just a few weeks. It all started with an earnings release that disappointed the market, but if we actually read the numbers, they weren't bad at all. Revenues and net earnings increased, and most operating metrics remained solid. One warning sign has been the rise of medical costs compared to the previous year. That's where the problem started. UnitedHealth has much more exposure than its peers to Medicare Advantage, a government-funded, privately managed program for US seniors. As government spending comes under pressure, UnitedHealth becomes vulnerable to cost-cutting policies. In April, new CEO Andrew Whitty acknowledged these rising medical costs and refused to provide future guidance. As a result, the stock dropped 22%. Weeks later, Whitty suddenly resigned for personal reasons. Stephen Hemsley, the company's former CEO and current chairman, stepped back in. The stock dropped again. Then, the Wall Street Journal reported that the Department of Justice is investigating UnitedHealth for possible Medicare fraud. Even though the company denied any official notification, the stock dropped again. At this point, more than half of UnitedHealth's market cap had been wiped out. That's $280 billion gone. Let's take a step back and get rational. The company's medical cost ratio has gone up, meaning it paid out more in claims. That happens in insurance. Some years costs spike, and the following year prices are adjusted to restore profitability. It's a cyclical business model. That's why this drop could be temporary and present a buying opportunity. Let's look at some key metrics. P/E ratio of 12, the lowest level in the last decade. Expected earnings growth over 10% in the coming years, probably to be readjusted at least for next year. Free cash flow yield of 10.8 and a very good gross margin of 22%. The debt is high, but more than half is covered by cash. Looking at dividend metrics, the dividend yield is above 2%, which is rare in the history of UnitedHealth. That's a good sign. The payout ratio of 35% makes the dividend sustainable, but it does not take into account any future fines that may be imposed on the company. One of the most impressive metrics is 15 consecutive years of dividend growth, ideal for dividend growth investors. As I mentioned in my video, The Magic of Compounding, when both share price and dividend grow, your yield on cost grows even faster over time. Now the big question is, are all the bad headlines already priced in? If yes, the stock may have only upside. If not, some risks may still be present. But risk is always part of investing. Our goal is to manage it, not eliminate it. And the best way to do that is to buy with a margin of safety. In your opinion, does the stock have a sufficient margin of safety? The answer will drive any decision. Let's see what insiders are doing. The CEO bought $25 million worth of stock, the CFO bought $5 million, 3 directors collectively acquired $1.6 million worth of UnitedHealth shares. That's a strong signal of confidence from the inside. Now let me show you a similar case. I want to walk you through a powerful comparison that helps put the UnitedHealth situation into perspective. It's a different company, a different story, but similar in terms of the reputational damage and the scale of the financial hit. I'm talking about 3M. 3M, the industrial giant, faced massive legal challenges related to forever chemicals, PFAS, substances that persist in the environment and the human body for decades. Due to contamination lawsuits, 3M ended up agreeing to a $10 billion settlement. At the time, it was a shocking figure. The market reacted immediately, the stock was hammered, and the company's reputation took a serious hit. While 3M's stock plunged, initially, over time, it recovered strongly and even surged more than 100% from the bottom. This shows a fundamental truth about markets. They tend to overreact in the short term, but normalize over the long term if the business remains fundamentally strong. UnitedHealth is now under pressure for a potentially massive fine, reportedly up to $30 billion. That's huge. It sounds like it could be devastating. When numbers like these are being discussed publicly, they often get priced in by the market well in advance. The worst-case scenario starts becoming part of the stock's valuation before anything even happens. Will the Warren Buffett famous quote will work? Be greedy when others are fearful, be fearful when others are greedy? This is not a financial advice. Always do your own research before making any investment decisions. If you don't consider this an ethical investment, that's perfectly valid. Everyone has their own criteria. Naturally, we can still expect volatility ahead, and yes, a potential recession could likely impact UnitedHealth, just like it would affect most of the stock market. That said, weigh the risks, form your own view, and let me know what you think in the comments. If you found this video helpful, leave a like, and if you haven't already, make sure to subscribe to the channel for more breakdowns like this. Thanks for watching, see you in the next one.